Buffett just released his annual shareholder letter, and there's a lot to unpack. This isn't just another corporate update, it's a rare look inside the mind of one of the greatest investors of all time. Let's break it down. Warren Buffett is 94 now, and he's making it clear. Greg Abel is set to take over as CEO of Berkshire Hathaway. Buffett even hinted that Abel might start writing the shareholder letters as early as next year. And here's an interesting insight. Buffett doesn't care where a CEO candidate went to school. He pointed out that his longtime business partner, Charlie Munger, didn't even finish 6th grade. His message? Great business instincts aren't learned in a classroom. They're built over a lifetime. Buffett is worried about climate change. His insurance company, Geico, didn't suffer major losses in 2024, but he warns that a catastrophic event is inevitable. It's not a matter of if, but when. And when it happens, the losses won't be small. Then there's Berkshire's massive portfolio. Half of its operating subsidiaries saw profits decline this year. That's a big deal, because Berkshire owns so many companies that its performance reflects the state of the U.S. economy. If more than half of its businesses are struggling, that's a sign that American companies aren't in the best shape. Still, Buffett remains bullish on the U.S. He acknowledges that America has its fair share of fraudsters and cutthroat competition, but it remains the best place to invest. There's one exception to Buffett's America First mindset: Japan. A few years ago, Berkshire started buying shares in 5 major Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These companies have global operations and hold stakes in diverse businesses worldwide. Initially, Berkshire agreed to keep its ownership under 10%, but as its confidence in these companies grew, it increased its stakes. Buffett sees these investments as long-term holdings that will be passed down to his successors. People keep talking about how much cash Berkshire has, but Buffett doesn't see it that way. While the company's stake in publicly traded stocks dropped from $354 billion to $272 billion, its investments in private businesses have grown. So the cash pile isn't as simple as it looks. Buffett also issued a stark warning about government debt. When reckless spending becomes a habit, the value of paper money evaporates. He believes the U.S. has come dangerously close to that point. That's why he doesn't trust long-term bonds. Traditional bonds don't protect against inflation, so when a currency weakens, bondholders get left behind. His advice? Stocks are the only real defense against inflation. Now, some people might point out that Buffett himself has been holding a lot of bonds, but here's the key detail. He's buying short-term bonds with yields over 4%, sometimes even 5%. These mature in just a few months, making them more like cash than a long-term investment. But long-term bonds? No chance. With rising inflation and growing national debt, locking money into fixed-income investments for decades just doesn't make sense. Buffett's message is clear. Despite short-term challenges, the U.S. remains the best place to invest. But investors need to be smart. Bonds won't protect against inflation, and cash alone isn't a solution. The real answer? Stocks. That's the breakdown of Buffett's latest letter. If this kind of insight helps, hit that like button and subscribe. More valuable market updates coming soon.